Someone's on a motorcycle. Okay. All right. Welcome in, everybody. Sorry about the late start, but we are ready to get going. So happy that you're joining us again for these regular board trainings and for inviting your boards. I won't take too much of your time. And those that don't know me, I serve as the CEO of the USG Foundation, and I, along with Amanda and Tracy and Jenna Wees, endeavored to pull these off regularly throughout the year. And we are keeping them recorded and in a library so that you and new board members that come on later can go back and reference them, or those who can't be on the call today can go back and view the content. So with that, we're super excited to have Truist here. I'm going to turn it over to Tracy, the USO CFO, to introduce the team.
Good morning. Thanks, Scott. And I do want to give a special shout out to you and Amanda and Jenna. I think these quarterly meetings thus far have been very beneficial in sharing information and best practices. So we are excited today to have 3 representatives from Truist Bank to talk about investment options that are available to our USG affiliated organizations. And so just quickly, as for background, we, through a competitive bid process, we contract with Truist Bank to provide management services for our pooled investment funds. They're going to tell you all things about that. We do this bid every 5 years. Truist was the incumbent and actually just was renewed through a competitive bid process effective July 1. So they will be servicing us minimally for the next 5 years. And they are really the ones that handle our day-to-day operations for all things investment. So today you're going to hear from Armand Reese. I'm not going to go into their bios because I do think we are short on time. I think the content is going to be way better than reading bios, but Justin Luthen and Julie Fields, and please do, when you speak, introduce yourselves. But we have their bios. If anyone is interested, we can definitely share that with you. But the team brings a wealth of knowledge and experience in this space. They do an excellent job managing the assets of several of our USG institutions and its affiliate. My last point today, before I turn it over, is that I want to make certain that it is understood that participation in these pooled funds is not mandatory. It is an option that is available to our foundations and affiliate organizations should you see the benefit. And I did want to point out there is also another opportunity, and this is outside of what Truist manages for our Georgia Fund 1 fund. It's a more liquid way of investing money, and that is managed through the Office of the State Treasurer. So many options, but I think Truist today is going to talk to you about the pooled investments and the benefits there. So with that, I will turn it over to Truist.
Okay, thanks. Scott, Armand said he is in the waiting room. Is that just wanted to mention, there we go. Okay, great. I think we have Armand on now. Is that correct?
Yes,
should.
good morning.
Armand, you're on now. Okay, great. Well, we're ready to get started. So we're kicking it off, turning it over to you.
Yeah, and as we get started, would it be helpful for me to share my screen, Scott? I do have our presentation pulled up, so happy to do that.
Yes, please do that. I've got the presentation, but I think it'd be easier for you to do that. Thank you, Justin.
Okay, great. So with that, I will turn it over here to Armand.
Well, good morning, everyone. It is always a pleasure to be with you all. For just as a quick introduction, my name is Armand Reese. I serve as regional practice leader for our Truist Foundations and Endowment Specialty Practice Group and secondary advisor on this amazing relationship. Joining me are certainly some familiar faces. Justin Luthen, who is the lead investment advisor for the pooled investment program, and also Julie Fields, who is the lead client manager for this relationship. Before we get into really the meat of the presentation, we wanted to really share just a high-level overview of who we are for some of you all that may not be familiar with our Foundations and Endowment Specialty Practice Group. We consider ourselves to be a boutique group within the construct of Truist, responsible for managing roughly $19 billion in assets under management for nonprofit organizations. Justin, Julie, and myself only work with 501c3 organizations. We do not manage personal wealth, 401ks, pension plans, or what have you. Julie, Justin, and I wake up every day thinking about how we can serve mission-based organizations that do good for communities, students, religious organizations, associations, and what have you. Our practice has the great thing about our practice is that we have very tenured professionals in excess of 20 years of nonprofit experience. And the beauty is that our group, Foundations and Endowment Specialty Practice Group, has been doing this for well over 100 years, still proudly serving one of our first private foundations that we started in 1925. So it has been obviously a lot of experience we bring to the table. Certainly, we haven't been there all 100 years. This I would look a lot different if I did, but nonetheless, but certainly Justin, Julie, and I have a tremendous amount of experience in working with nonprofit organizations. And one last thing I want to highlight is that our average client tenure is in excess of 18 years. And that's something we are certainly proud of as we have go out to rebids and work with clients who kick the tires, very much like you have done here recently, which we were fortunate enough to win the rebid for 10 years. But our average client tenure is 18 years, and it's something that we're very proud of. Just given that, I think it speaks to our client service, our client support, the performance we deliver, the white glove service, which is certainly beneficial to the clients that we work with each and every day. To drive a little bit more specific to really the Board of Regents, and again, this relationship that is extremely important to not only the Foundations and Endowment Specialty Practice Group, but our entire company, our entire organization, all the way up to our CEO, Bill Rogers, because what we do from a mission standpoint of view really aligns with the Board of Regents, and our mission is to serve communities each and every day. So our partnership proposition that we have committed to the Board of Regents is really on the left side, is what we do. We specialize in nonprofits, which I've highlighted in the page earlier. Our focus is deliver solid outcomes so that you can go and spend the money from the portfolios that you've entrusted us in managing to support scholarships or what missions that you are responsible for. And then obviously to provide comprehensive administrative solutions. We believe these benefits translates into certainly an experienced and specialized team. As I said, in excess of 20 years of nonprofit experience through Julie, Justin, and myself, providing strong absolute relative returns from being keenly aware of what the market is doing, ensuring that we are positioning the portfolios to capitalize on growth, so that you can obviously apply a spending policy that would support, again, your objective. And then lastly is cost. One of the things we pride ourselves on is really focusing on cost with this particular relationship. Just given our focus on education, scholarships, we understand how saving an additional dollar within this portfolio is an additional dollar you can give towards scholarships or your mission-based organization. So that's one thing we have prided ourselves in really being very cost sensitive in how we go about managing the portfolio and providing what we believe to be an amazing solution to the USG system. The next page really continues along that partnership proposition and really how we go about doing it. So moving from what we do to really how we do it. So one of the things that Justin, Julie, and I really focus on is providing that tailored investment advice. While we have fortunate enough to manage 6 pooled investment strategies, we sit down with each and every participant that is in the pool strategy to talk about what is the appropriate risk tolerance? What return objective are we trying to achieve? And based on that information, we look at the pooled investment strategies that we are managing and determine what would be the vehicle that would help achieve that ultimate that goal. And then obviously having an agile investment process, keeping our ear to the ground in terms of the economy, market data, positioning the portfolio based on our best thinking in terms of asset allocation. Do we like large caps? Do we like domestic equities? What are our thoughts on international equities? What are our thoughts on China, in emerging markets in general, or fixed income? And then building that culture of partnership, certainly with each and every participant. Certainly while we work with Tracy and team from a board of regent standpoint of view, it is very important to us that we developed a direct relationship with each campus, each foundation, each staff member that touches this relationship, because we think that's important, and just making sure that we are delivering not only the investment support, but also the administrative needs for each individual campus. So it is truly a tailored solution, and providing that suite of portfolio options, conflict-free open architecture platform, which means that there are no Truist funds on our platform. There is nothing that we are biased towards in terms of a manager. We look at each manager that are approved on our platform objectively, and when we add it to the portfolio, our goal is to make sure that it is set to do what it is expected to do, which is generate performance given the market environment. And then, as I said, pricing enhancements resulting in scale and efficiency. So again, weighing all these benefits, we think is supportive to the overall pooled investment program. So on the next page, I want to highlight just the amazing growth that we have seen within the pooled investment program. And certainly while we have been fortunate enough to be your advisor since the very beginning, since 1991, I think it's just is amazing to see the tremendous growth in the portfolio, as well as the participants that have been along for the journey as the market has been supportive, as we have provided solutions that have met each and every needs, or met the needs of each participant that has been in the strategy. So if you look to the far left, the left axis is the assets in terms of it's slotted in millions, and on the right axis is the participants. The line shows the number of participants that have been a part of the pooled investment strategy since the very beginning, and the bar chart illustrates the growth in millions, or it's stated in millions. And as you can see, we've grown from roughly 24 million to now exceeding $1.9 billion in assets under management. And as again, along the way, as participants in terms of colleges and universities, foundations, cooperative entities have joined the pool participants, and has been a part of the success of the markets, and certainly the partnership that we have established over this longstanding relationship. So, again, another thank you to each and every one of you who are participants in the pooled program, and again, appreciating the partnership. The next page, please. What I'll do is turn it over to Julie and really speak to, again, our commitment to education and some of the administrative solutions that we have pulled together, and certainly in ways that we support the Board of Regents relationship. Julie?
Julie, you're on mute.
Sorry about that. It's great to see so many familiar names in the list, and so I'm excited to be able to share with you all this morning. As Truist, as Armand mentioned, Truist is committed to our mission to inspire and build better lives and communities. And we recognize the critical role that Georgia's colleges and universities and their affiliate foundations play in that mission. We understand the importance of your mission in supporting those institutions. Since the merger, we've deepened our financial service capabilities across the Truist platform. We are committed to providing USG with the full range of services that Truist has to offer. As you see on the map, represented by the star, we have Truist branches near every USG institution, and we work closely with our banking partners. We embody the one-team mindset when it comes to servicing our clients throughout the state. Next slide. Also, as Armand mentioned, Truist has a long history with the Board of Regents Pooled Fund Program. This list represents the participants in the pooled fund. The important thing here is to note that we recognize that every participant listed here is important to the system and is unique. Each one is bringing their own unique history, board structure, development programming, and so much more. And by interacting and building relationships with all participants, we deepen our understanding of your unique needs. Many of the tailored solutions that we have to offer today are the direct result of extensive input from our program participants like you. Next slide. And as they say, it takes a village. And what you see here is your village of top-notch professionals who serve the relationship on behalf of Truist every day. As you have heard from Armand Reese, lead investment manager, Justin Louthan, you'll be hearing from shortly. Myself, I'm Julie Fields, and I'm the client manager for the relationship. James Bernal is a name that I'm sure many of you recognize. James is the man behind the curtain when it comes to administrative and transactional accounting. And Demi Moore is the lady behind the curtain that supports all of us as well, and supports specifically Armand and Justin as the portfolio analyst. I also think we know that it is worth noting, and we are very proud of the fact that every one of the teammates you see listed here that serve the Board of Regents Pool Fund Program are a product of the University System of Georgia. And we're very proud of that, and go Dogs. So we recognize that your time is valuable. I have spent many years working in foundations. My career started at the University of Georgia in development and alumni relations. So I'm very aware of the many constraints that there are in terms of your time. And so we recognize that your time is valuable, and our goal when it comes to the administrative solutions is to provide services that streamline your work and give you time back to focus on your mission. And while it will take too much time today to share all the ways that we support our clients, I'm going to briefly highlight a few here. So we meet with all participants every 12 to 18 months for an in-depth relationship and investment review. We, again, value the opportunity to get to know each unique client. We meet quarterly with many of the participants, not only to provide a performance update, but to spend some time with staff and board members. So depending on your meeting cadence, we meet with some foundations quarterly, some annually, but our goal is to meet with every single participant in the pool fund at least once a year. We provide assistance when it comes to developing and or revising your foundation's investment policy statement, and we review and often tweak and help you revise your spending policy, your foundation spending policy. We assist many participants in the pool fund with their annual audit, often specializing and providing customized fund accounting or customized audit reports based on audit requests. And we believe strongly in professional development for our clients and for ourselves. I recognize many of the names on the list today because we have been a proud sponsor and partner with the Georgia Education Advancement Council, the GEAC annual conference, for over 20 years. And we participate in the annual University System of Georgia Chief Business Officer Conference. This allows us just another opportunity to interact with many of you and our key contacts around the state, and get to know you better and spend some time sort of outside of the regular business of the day, getting to know our clients and building those relationships. We also participate in our own professional development opportunities so that we are well versed in the challenges and opportunities within the higher ed landscape. We know the more and the better informed we are about what's going on, not only in the nonprofit world, but in the higher ed space, the better we can provide the very best solutions to fit the needs of you, the Board of Regents participants. And last, but definitely not least, we provide customized fund accounting. We currently provide many of the pooled fund participants with customized fund accounting reports, tracking over 600 individual funds. As I'm sure you are aware, a healthy, smooth operating fund accounting process is a critical component for nonprofit organizations. Utilizing Truist for your fund accounting processes does 4 things. It saves you time. Time so that you can focus on your mission of raising money and stewarding your donors. It saves you risk. Fund accounting is a risk management tool. A healthy fund accounting program protects you from audit issues, human error that comes from staff changes, donor frustration, and much more. It bolsters confidence in your communications with your donors and potential donors, and donor confidence in you that their gifts are being handled according to their wishes. And lastly, it saves you money. As we've mentioned, time is money and money is money. And we are fully staffed to offer fund accounting to pooled fund participants, and we offer this at no additional charge to participants in the pooled fund. Just this year, we worked with 3 foundations to reset and establish a healthy fund accounting process. And we continue to offer this service to anyone that's interested in learning more about fund accounting as is done through the Truist platform. And now I'm going to turn it over to Justin to show you how Truist serves you as your investment partner.
Thanks, Julie. So again, I am Justin Louthan. I've been with Truist a little over a year and a half, but in the industry for much longer than that. And I am responsible for the day-to-day management of the Board of Regents Pooled Investment Program. Maybe before I get started here, I did see a question come up on fees. Certainly we will talk about fees as I kind of go through the rest of the presentation, and then we'll open it up at the end as well for any additional questions that we did not address. But as we kind of go through the investment process and the pooled investment program, as Armand and Julie have both spoken to, while we provide a number of services to the University System of Georgia, one of the most important services or benefits or value add services we believe we provide is the pooled investment program, which really allows us to aggregate assets from each University System of Georgia participant, use economies of scale, which provides asset access to best in class managers and investment strategies, and also allows us to do this at a very low cost. So if each participant was out investing assets on their own accounts, certainly costs would be higher from both an investment perspective as well as time spent managing these assets. And so by aggregating all of these assets, we're able to do this in a much more efficient and low cost manner. As I believe we mentioned, the pooled investment program does include 6 pooled investment funds or portfolios, which really range across the risk and return spectrum. And so each of these pooled investment vehicles does have different investment objectives, different time horizons, and accordingly different return expectations. And so really our goal at the end of the day is to achieve the needed investment return for each pooled investment vehicle using the least amount of risk or having the least amount of volatility possible to achieve the necessary return associated with the fund. And we use a pretty iterative process to construct these portfolios to achieve these investment objectives. And if you kind of look at this page here on page 11, it really starts at the top and with our investment philosophy. And certainly we incorporate our global macroeconomic research, as Armand alluded to. This incorporates, GDP growth across different parts of the world, interest rates, in some cases, geopolitical events, and a number of other economic indicators so that we can get a better feel of the overall health of the global economy and different segments of the economy. We use this information to really develop our capital market assumptions. And when I say capital market assumptions, I mean expected return assumptions for different asset classes. So this could be Return and risk assumptions associated with equities, associated with fixed income. Certainly, as many of you probably know, but expected returns are higher for equities than for fixed income, but also come with a higher degree of risk. And so our goal at the end of the day is to balance this out so that we're not taking too much risk to achieve the desired level of return. Once we develop these capital market assumptions, which we do on an annual basis, this is something that is ongoing and iterative. It's not something we look at once and then go out and invest, but we revisit this annually, and we are kind of looking over a 10-year time horizon. And so we do use these capital market assumptions to, at the end of the day, develop the overall strategic asset allocation. And when I say strategic asset allocation, what I mean is how much of the portfolio are we going to dedicate to equities? How much are we going to develop to fixed income? And then how much are we going to potentially have in class or some of these more non-traditional asset classes? And then even within the equity buckets, there are sub-asset classes. There's U.S. equities, U.S. large cap equities, U.S. small cap equities. Within international, there's developed markets and emerging markets. And so what we try to do is determine the target allocations to each of these asset classes using our risk return analysis and some modeling to come up with the most efficient most efficient portfolio based on desired risk and return levels. And so once we do this, we do set the overall strategic asset allocation, and then we'll work with each institution that participates within the investment program to incorporate these strategic asset allocations into their investment policy. And certainly this is important for documentation purposes so that you're aware of what your overall risk and return expectations are, what your investment objectives are based on the pooled investment vehicle that you may choose. And so we will work with you to make sure that this is incorporated into your official investment policy. Once we have the strategic asset allocation set, we then have to focus on implementation. So we want to have, say, 65% of the portfolio in U.S. equities. How are we going to do this? What managers are we going to select? Are we going to use active or passive implementation? And when I say active versus passive, we do use a combination of both. And passive implementation is essentially using an index fund that mimics a particular index, such as the S&P 500. And maybe that's a good example. So we do believe that some asset classes are more efficient than others. So, for example, U.S. large cap equities. That's been a tough asset class to outperform in over the past several years. And so as a result of that, we think the best way to approach this is simply to index this asset class. So we go out and we buy an index fund and we gain overall market exposure. And we also reduce costs by using passive instead of active management. However, there are other asset classes where we think that we can achieve alpha or outperform the broader market. So within these asset classes, while it may come at a little higher fee, we are looking at this on a net of fee basis. We will implement active management. And so we use a manager of manager approach where we are the overriding manager, but we do use underlying mutual funds and investment managers to allocate to each asset class. And so we will use active management where we do think that it gives us an advantage. And then as part of this, we do conduct extensive due diligence on any investment strategy, any investment manager that we utilize or work with. So this includes manager interviews, qualitative as well as quantitative analysis. So in addition to historical performance and risk, we are looking at qualitative perspectives, looking at the overall portfolio management team, looking at their philosophy and process. Have they achieved the returns that we would expect them to in particular market environments? And so we put all of this together to make sure that we are utilizing best-in-class managers, those managers that we think are going to outperform over longer time horizons. And then these are the managers and strategies that we will utilize within these portfolios. And then lastly, portfolio management. That's an ongoing process. That's what I do on a day-to-day basis. And so we will make adjustments to the overall strategic asset allocation. So while our strategic asset allocation is certainly serves as kind of the starting point and the term and accounts for the long-term views of our overall portfolio construction process. There are market environments, where that may deviate from our longer term, broader views, and so we will adjust portfolios accordingly. Now we do have, certain ranges that we have to operate within. So, for example, say our target exposure to U.S. equities is 65%. We may be able to go up to as high as 75% or as low as 55%. But within that, we do have some ability to move around, and we do make adjustments based on these allowable ranges and based on our current economic and asset class views. And so we adjust portfolios rather frequently based on these views. And maybe a good example of this is the past 2 years. As I kind of mentioned, U.S. equities have outperformed pretty significantly. So as a result of this, we have overweighted that asset class, which has served the portfolio well. And we really use our global macroeconomic research to validate this. So GDP growth has been higher in the U.S. over the past several years. Corporate profitability has been higher in the U.S. over the past several years. And so we take this knowledge and this information and have overweighted U.S. equities over the past couple of years, as we believed it would be advantageous to participants, and allow us to achieve the returns that we want to by moving away from the overall strategic asset allocation. So I spoke to this a lot, but if we jump ahead here to page 12, just to kind of speak to strategic versus tactical. Again, the strategic asset allocation is really designed to provide the foundation over the longer term to make sure that long-term investment objectives are fulfilled. However, we do use tactical asset allocation to capture returns as asset classes are expected to outperform or underperform over shorter time periods. And so, as I mentioned, strategic asset allocation is longer term in nature, 5 to 10 year views, whereas tactical asset allocation may be as short as 3 months up to kind of a 3-year time horizon. And so we will rebalance the portfolio accordingly. Our strategic asset allocation, additionally, that is in line with your investment policy statement. Changes to this are pretty infrequent. From year to year, we don't have large changes to our overall asset class views or our long-term asset allocation. So we stick to this over longer time horizons. We don't expect there to be frequent changes from year to year. However, our tactical views do change frequently. And so we may make changes based on this 2 to 3 times a year, depending on the current market environment. And so all that to say, while we do, the larger focus is on strategic asset allocation, it's not a static portfolio. We do make changes based on the current market environment. So that was a lot. I'll take a pause there just to see if there are any questions on that before I jump ahead here to page 13. Okay, great. And certainly we can come back at the end if there are additional questions. This is a very busy page. For those of you, it's probably been a while for most of you, but for those of you who took chemistry in high school or college, this looks very much like the periodic table. We refer to this as the periodic table of asset class returns. And so what this really shows is how different asset classes have performed on a calendar year basis. And you can see that, really across different time horizons, what may have been the best performing asset class in one year may have been among the worst performing asset classes in the year that followed or 2 years later. And certainly we are trying to limit volatility. And so we do think that this kind of alludes or speaks to the importance of diversification within portfolios. We do believe in diversified portfolios. While any particular asset class may do extremely well over a 1, 2, 3 year time horizon, over time, markets do tend to mean revert. And certainly when markets are down, we want to limit that downside volatility because we know that it can have a significant impact on overall spending or dollars available to the foundations and university system participants as a whole. And so we know that that's extremely important. And just keep in mind that for every 50% lost, negative 50% return, you need 100% return just to get back to the initial starting level. And so as we manage these portfolios, we certainly keep this in mind. As I speak to this page, I kind of like to use a bowling analogy as I kind of go through this. And so if you think about bowling, I know when I go bowling, I'm often trying to bowl for strikes. And so I bowl hard and fast in hopes of getting a strike. But oftentimes hit the gutter. And so in those situations, the outcome is very poor. When I do get a strike, that's great, but results in a lot of volatility in my score from round to round. And so, every Thanksgiving I get together with my family, have a lot of 2 and 3 year olds running around, and then they go bowling with us. However, we put up bumper guards in their lanes. And so when they bowl, whether they bowl fast or slow, it bounces around a lot, but it ultimately tends to hit the bumper, bounces back to the middle. And I can tell you that while they don't bowl too many strikes, they may knock down 7 or 8 pins every single time. And so while our end result may be close to the same, they are much more consistent and have much less volatility associated with their bowling score than I tend to. And that's really what we're trying to achieve in the context of managing these portfolios. And so all of the portfolios that we manage are all of those diversified portfolios. There are a couple that are more short-term in nature, but for all of the diversified portfolios, you can think of those as being somewhat in line with the asset allocation portfolio. And you can see kind of the line that goes through the page. In any given year, it's never the best performing portfolio, but it is never the worst performing portfolio. And so we are limiting volatility by doing this. And over longer time horizons, we tend to stick closer to the middle and achieve the desired level of returns within these portfolios. It's much more consistent. So if we have a return objective of 7%. The last thing we want to do in a given year is be down 25%. That's not to say that the portfolio return will never be negative, but hopefully not as negative as the overall broader market. And if you kind of look over time, we have been able to achieve this. So if you kind of look from 2010 to 2024, again, not at the top of the page, but we are closer to the top than the bottom, and certainly with much less volatility than the overall broader market or many of the asset classes that are incorporated into these portfolios. And so, again, the goal here is to provide a much smoother ride than by just betting on a single asset class. And if you get it wrong, you may be towards the bottom. So if we flip ahead here to page 14, this shows 4 of the funds available through the pooled investment program. And so there are a total of 6 investment funds within the pooled investment program. The first of those being the short-term fund. And this is really, the short-term fund is really limited to investment grade corporate bonds as well as treasuries that really have a duration of 1 year or less. As this pool tends to be used for day-to-day operational needs, very short-term in nature, and so it's not as diversified as the other portfolios. Therefore, we did not include it on this page. But for the funds on this page, it kind of goes in order from most conservative or least amount of risk and a lower level of return to most aggressive or most diversified, which comes with a higher rate of return, but you do take on a little bit more risk. And so we start here at the top of the page. The first fund that I'll speak to is the Balanced Income Fund, which has an overall equity target of 65%. Or an overall equity target of 35%, an overall fixed income target of 65%. Sorry, I thought that I just lost you, but the equity portion of the portfolio in this instance is going to be limited to 100% U.S. equities, diversified among large, mid, and small cap equities, with the large majority being in those large cap equities. Again, equities tend to be more aggressive or more volatile in nature over time. And so certainly you do expect a higher return associated with equity exposure versus fixed income securities. But that does come with more risk. And so this is the most conservative of the portfolios available to BOR pooled investment fund participants. Next is the total return fund. This is essentially the inverse of the balanced income fund. And so you have about a 70% target to U.S. equities, whereas you have a 30% target to U.S. fixed income. Again, that equity exposure will be limited to U.S. equities, diversified across U.S. large cap, mid cap, and small cap equities. So this gets a little bit more aggressive in nature. You can expect a somewhat higher return associated with this investment portfolio relative to the balanced income fund. Next is the diversified fund. The overall equity exposure for this particular fund is in line with the total return fund. The difference here is we introduce international or non-U.S. equities. And so within the equity exposure, we will have some developed market as well as emerging markets equities. And so by doing this, we provide additional diversification, the potential for a higher return over time. But again, you do have, you probably have, depending on how you look at it, you are more diversified. So that does take some of the risk off of the table, but you are introducing international markets, which over time have been more volatile than U.S. markets. However, we do expect that over longer time periods, you do have a return premium in excess of U.S. Market returns. So you could potentially achieve higher returns by investing in the diversified fund. And then lastly, we have the diversified fund for foundations. And here we do introduce non-traditional asset classes. So those outside of traditional equities and traditional fixed income. This may include long-short equity funds where managers have the ability to short equities, meaning bet against U.S. equities going up or bet for them going down. Additionally, you may have some exposure to other esoteric segments of the market, such as private credits, maybe a little bit of private equity, some commodities exposure, some real estate exposure. That said, this is all done through a mutual fund format. So you do have daily liquidity. In none of these funds do we have any lockups. Everything is liquid on a daily basis. So you can make daily withdrawals, but this does provide some exposure to some additional asset classes. And this particular fund, the Diversified Fund for Foundations, is only available or only accessible by foundation participants, giving some of the more non-traditional asset classes and liquid alternatives. But again, we do think that it does provide some additional exposure, and at the end of the day could result in a more desirable return outcome. So I'll take another brief pause there. I did just give you a lot and then spoke to the four primary funds from a diversification perspective, but we'll take a pause there just to see if there are any questions on what I've said thus far.
Thank you for that. This is set up as a webinar, so the participants actually don't have access to their microphones. So if you do have questions, we ask that you just type them into the chat bar, and okay. We'll be monitoring that.
Okay, great. Here on page 15, we do show all of the 6 funds. So if you kind of look at the table on the right, we start with the short-term fund. That's going to be the most conservative fund. You can see that the assets within this particular fund are the largest, sitting at around $760 million as it stands today. And then as you kind of move down the page, the return generally gets higher over longer time periods, albeit taking on more risk. So you can kind of think of it as going from most conservative to most aggressive. And if you look at kind of go across the table, kind of looking at that 5-year time horizon, This is essentially or generally in line with the returns that we hope to achieve or expect to achieve for each fund, kind of over a full market cycle. So again, the short-term funds, at around 2.6%. This is very short-term in nature, taking on very little risk. And as a result of that, you would expect a lower return within this particular pooled investment vehicle. You don't have access to the legal funds. This is somewhat of a legacy fund that I don't believe foundation participants have access to, so I will not speak to that one. But if you kind of look at the balanced income fund all the way down to the diversified fund for foundations, you can look at the returns over time. I spoke to the diversification within each of these portfolios on the last page. But if you look at the 5-year return for the balanced income fund at about 3.8%, as you kind of move down, returns do generally get higher, all the way up to about 9% for the diversified fund for foundations. And so this is what we would kind of expect over time. I will say total return fund has outperformed the diversified fund over more recent time periods in light of U.S. equity markets outperforming. But generally speaking, I think that this gives you a good idea of what you can kind of expect from each fund based on the investment objectives for each fund, along with the desired level of risk taken. And then here on page 16, we do compare this to your peers, or our investment performance compared to peers. And so we only included 3 of the funds on this page that is more in line with the diversification for other endowments and foundations. But this is a study developed by NACUBO and Common Fund, which basically is a national survey of all endowments and foundations that ask for various information, what they pay for fees, how they're allocated, their performance over time. And you can see that really all 3 of these funds stack up pretty well on a national basis relative to other foundations and endowments, both of similar size to those within the Board of Regents Pooled Investment Program, as well as those that are even larger. So you can kind of look at those from $1 billion to $5 billion. And given the outperformance of public equity markets over the past several years, you're really stacking up quite well even to some of those larger institutions, which include the likes of your Harvards, your Yales, and so forth. And so we do think that we have implemented a very competitive investment program. Again, this is just a point in time, so not to say that we'll outperform in every market environment. But we certainly do believe that we stack up well relative to our peers over various time periods.
And Justin, if I could just chime in here, I think something worth noting, particularly for this NACUBO survey, is as you go up in asset value and you think of the Harvards, the Stanfords of the world that have these large endowments that typically include private capital strategies that are illiquid in nature, but over long periods of time really unlocks a liquidity premium that translates into higher performance. And we have really been intentional in structuring the Board of Regents strategies, particularly the total return diversified funds and certainly diversified fund for foundations, to have a liquidity focus so that there is no illiquid strategies that are held in those funds, because we want to ensure that when there's a need to draw down on a particular strategy, that we can raise that capital fairly quickly and make it available for the participant. And so that can create some performance dispersion between how we've intentionally constructed the Board of Regents strategies versus some of those large or entities that have private capital strategies in there where liquidity may not be a primary factor. So I wanted to just highlight that as a point of note, particularly as you compare performance relative to some of the various NACUBO ranges.
Yeah, no, that's a very good point, Armand. And yeah, again, many of these institutions have 40+% of their portfolios locked up in private capital strategies that have time horizons that are essentially locked up or illiquid for 10+ year periods. And so if you think about not being able to access in excess of 40 of your portfolio for more than 10 years, you have to justify that with a pretty substantial return premium to lock up that capital, and so we have structured these portfolios accordingly. And then lastly, just touching on fees here on page 17. And so I think this is, among some of the largest value add that we are able to bring to the Board of Regents pooled investment program. We think that we have a very, very competitive fee schedule. It is a tiered fee structure. Certainly, if you kind of look at the top of this page, we have two different fee structures. One pertains to the short-term and legal funds. Given that these are very short-term assets, all fixed income, the management fee for these portfolios is lower than those more diversified portfolios, as one might expect. But you can see, as you kind of go down, if we start on the left-hand side of the page with the short-term fund and legal fund fee schedule, on the first 500 million at 8 basis points. Once you get to 500 million, the next 500 million, we charge 6 basis points. And then anything above $1 billion, we're only charging 5 basis points on. And again, similar to the investments, we are looking at all participants in aggregate. So if one institution, has a very small portion of assets, we're looking at the university system and all participants as a whole. And so as we stand today, based on the different tiers, the effective fee schedule today is 7.3 basis points for these two funds, and that includes the sub-advisor fee. If you look on the right-hand side of the page, again, given that these are more diversified and sophisticated portfolios, the fee structure is higher than it is for the short-term fund, but certainly still very competitive. On the first 250 million, we charge 15 basis points. On the next 250 million, 8 basis points. And then once you get to 500 million, we're charging 5 basis points beyond that level of investment. So for the balanced income fund, the total return fund, diversified fund, and diversified fund for foundations, as it stands today, the effective fees charged on those portfolios is 9 basis points. And so again, we think relative to competitors and peers, we bring a very favorable fee schedule to the Board of Regents Pooled Investment Program. So I'll stop there. Spent a lot of time on this. I didn't leave a whole lot of time at the end, but that's all the prepared comments we have. But certainly want to open it up for any questions or any other remarks that need to be made.
Not seeing any coming through on the chat, but some thank yous, of course. I guess it would go certainly without saying how appreciative we are at the USO for the partnership with Truist. It is a stalwart, long-standing one, and certainly much appreciated across the state. So I didn't know if there are closing comments that Armand, you or Julie or Justin would have, but on behalf of the USO, we want to thank you for coming in and leading us through this today. I think it was super information for folks that might have just taken for granted what's happening behind the scenes with the large-scale money management that Truist is undertaking on our behalf. So thank you for that.
Well, Scott, I will just close us out just with a note of thanks and just an appreciation of the partnership, the longstanding relationship. As you know, it is very widely known within our organization. As I said earlier, going as high as our Chief Investment Officer, Bill Rogers, who is super proud of this relationship. And we're just honored to be the team with Justin and Julie taking the lead on that to serve you as well as each and every participant that is in the pooled program, recognizing that the work we do really is meaningful. And it supports students throughout the great state of Georgia. So again, thank you for this opportunity to continue the partnership for another 10 years.
Thank you. If I can just add, this is Tracy. I'm surprised we didn't get the question. Normally after in the presentation, the first question is, can we get a copy of the presentation? So we'll definitely share that with the team. And I know all of their contact information is included on there. So feel free to reach out if you have additional questions. So thank you.
Yes, please don't hesitate to reach out with any questions that may come up after this. So thank you.
And this was recorded today. As we said, we'll be making this available in the board training library online. We actually have a YouTube access for that to make it easy. So we'll be sending that information out as well. So as always, thank you for your participation, and we will be reconvening again in the near future. Try to do this quarterly, give or take. So we'll be letting you know about details about the next gathering for this. So thank you very much.
Thank you
Great.
all.
Have
Thanks,
a great
everybody.
day.
Bye-bye.